With options trading, you can make money if the stock is up or down, recession or not. Plus, you don't need to own the stock in order for you to make money from the stock. And most importantly, you can start with $100, $1,000, $10,000, whatever you're comfortable with. Hi everyone, it's the Portfolio Plug. In this video, you are going to learn the basics of options trading so you can take advantage of this recession to build wealth and gain financial freedom. First, let me explain why you should consider options trading versus only buying and holding stocks for the long term. When you invest in a company, ideally you want to buy that stock and hold it for at least 10, 20 plus years in order to maximize on the return on your investment. However, everyone might not have the luxury to hold these stocks forever, especially during these tough times with high inflation and the cost of living is through the roof. With options trading, you don't need to wait for 5, 10, 20 plus years in order for you to get a return on your investment. You can make your money in a day, weeks, months, all in the short term. Also, some stocks may just be too expensive to own. But with options trading, you don't need to own the stock in order to make money from that stock. Let's take the S&P 500 for example. Say if you would like to own one share of the S&P 500, SPY, that's the ticker symbol. In order to own that one share, you would need to have $350 to $400 plus just to own that one share, depending on what the current price of the S&P 500 is. However, if you don't have that amount, you wouldn't be able to buy it because you would have to buy it in full as a whole. But with options trading, with $100, $200, you don't need to have the exact amount of the current stock price in order for you to trade the stock and make money from that stock. Most importantly, when you purchase a stock, in order for you to get a return on your investment, the stock actually has to go up from the original price that you purchased it. So if the stock is going down, you will lose. But with options trading, if the stock is going down, you can still make money while the stock is going down. Even right now, with the stock market being down 25 to 30%, where everyone is panicking and looking at their stocks going down, their portfolio going down, you can hedge the market as it goes down so you can make money on the market. That's what options trading allows you to do. Now that you know the benefits of options trading, what is options trading and how does it work so you can take advantage of this recession to build wealth and gain financial freedom? Options trading is a financial contract that gives you the right but not the obligation to buy or sell a stock at a specific price within a time period. In other words, this is an agreement between you and your broker, whether it's TD Ameritrade, Fidelity, E-Trade, Schwab, Robinhood, or any other brokerages that's out there. Essentially, you are deciding if you think the stock will go up or down to a specific price within a time period. If you think the stock price will go up, then you would buy a call option contract. If you think the stock price will go down, then you would buy a put option contract. For a call option, it gives you the right but not the obligation to buy that stock at a specific price within a time period. In other words, you are betting for the stock to go up to a specific price within a time period, and you would make a profit when the stock price goes up. Something to keep in mind. It does not have to go to that specific price. As long as the price goes up, you will make a profit. For a put option, it gives you the right but not the obligation to sell the stock at a specific price within a time period. In other words, you are betting for the price of the stock to go down, and you will make a profit as that stock price goes down. The specific price that you think the stock will go up or down to, it's called the strike price, also known as the exercise price. The strike price is the most important factor to determining the option's value. For a call option, the strike price is where the stock can be bought, in other words, can be exercised. For a put option, the strike price is where the stock can be sold. Before I go into the next part of understanding the basics of options trading so you can take advantage of this recession to build wealth and gain financial freedom, I would greatly appreciate it if you hit the subscribe button and leave a thumbs up if you find this video to be helpful. The time period for a call or a put option where it can be bought or sold, that time period is known as the expiration date. The expiration date is the last day that the options contract is valid. On or before this day, you will have three options. Option number one, you can close your contract for either a win or a loss. Option number two, you can exercise your contract. And option number 3, you can let your contract expire worthless. When buying a call or a put option contract, you need to understand the options premium. The premium is the current market price of the options contract. You will see the ask price and the bid price for the premiums. The ask price is the lowest price that someone is willing to sell a share, and the bid price is the highest price that someone is willing to pay for a share. Always buy at the ask price in order to get the lowest price for your contract. Something else to keep in mind, one options contract is equal to 100 shares. You will see that the contract prices are broken down in cents, dollars. You have to multiply it by 100. That will give you the actual cost that you're paying for that option contract. And you're multiplying it by 100 because one contract is equal to 100 shares. Let's take a look at this example of what a call option and a put option will look like. Apple, that's the ticker symbol for Apple. Apple, February 17th, 2024, $165 call at 0.39 cents. That means I am buying Apple calls betting that the stock is going to go up to $165, which is the strike price, by February 17th, 2024, which is the expiration date. And I am paying $39 for that one contract because 39 cents, if you multiply it by 100, you are going to get $39. That will be the cost of that one contract. As the stock price of Apple goes up, I will make a profit and I can close my contract and collect on my profit. I don't have to hold it until the expiration date. The second example, I'm going to use Walmart. Let's say that Walmart is currently trading at $140 a share. I am going to buy a Walmart February 17th, 2024, $125 put at 47 cents. Because I am buying a put contract, that means I am betting that the stock price of Walmart is going to go down to $125, which is my strike price. And I am betting that it will happen by February 17th, 2024, which is my expiration date. And I will be paying $47 for that one contract because it costs 47 cents. So if you multiply 47 times 100, it gives you $47. And as the stock price of Walmart goes down, I make a profit and I can close on that contract and collect my profit. I don't have to hold it until the expiration date. Last but most importantly, aside from being able to make a lot of money in such a short amount of time without having to own the stock, if you don't understand proper risk management when it comes to options trading, you will easily lose your money. In the next videos, I'm going to teach you how to have proper risk management, the psychology of trading, technical analysis, how to properly chart and break down stocks, understanding the options chain, the different strategies that I use to make profits, what stocks you should be trading with, and a lot more so you can take advantage of this recession to build wealth and gain financial freedom. If you find this video to be helpful, subscribe, leave a thumbs up, share with a friend, and if you have any questions, thoughts, leave it in the comments. And thanks for watching. I'll see you in the next videos.